Welcome to my economics channel, where I love discussing the subject, but most importantly, I love to make something fun and interesting to learn. And to that end, today's video will expose more bad economics, specifically on the subject of inflation. And the person doing this bad economics is actually me. Yes, me, normally the person who is exposing others for doing bad economics and having really big audiences and spreading a lot of nonsense like Economics Explained. However, today I actually have to correct the record on myself. And previously I made a number of videos where I claimed that all of the stimulus done by the Federal Reserve and other central banks and indeed governments working together wouldn't lead to inflation. Now, I had various reasons behind this, but ultimately none of it was really rooted in any economic models or really broadening the scope of my research, which is something that I especially want to fix today. I have way more sources and that are way broader than what I was looking at before. And so to that end, I've assembled 26 sources. Now, you will notice that quite a few of these are from Financial Times and The Overshoot, both of which are paid subscription services. And now, of course, if you haven't paid for these services, me posting the links doesn't really do much for you. And I also can't show much from any of these sources. However, I've also got other sources as well, free to view ones, which can also verify the veracity of my claims. And so I definitely recommend you check out those below. And so a brief overview of the video is as follows. We're going to have what is and isn't inflation. Then we're going to have the broad causes of inflation, all of the causes that I could find across all of the different sources. And then I'm going to be going into each source in detail, what each source has to say about the inflation that we're facing right now and just how severe inflation is. And so I hope you'll sit through this admittedly lengthy video where I can redeem my take or my takes on inflation and this time actually get it correct, because of course that's important, especially going forward. And we need to understand what is causing inflation and what might happen with inflation going forward. And we want to be armed with the best information, best knowledge that we have. So without any further ado, enjoy this soothing B-roll and let's get into the video. And so before we get started, I will lay out all of the causes of inflation that we are seeing right now. And all of these are taken in total from all of the sources that I have utilized. Number 1, the war. Number 2, housing price rises, caused to a substantial degree by people working from home and choosing to live further away from the city. We currently have excess demand for housing, and this is not being met in most countries around the world. Number 3, we have an oil price shock. Number 4, monetary and fiscal stimulus. More specifically, the Fed and the US government both enacted stimulative policies. Also, the general consensus is that the government stimulus in 2020 was good. However, the stimulus in 2021 was bad. It was simply too much. Number 5, the Fed started raising rates too late. And more specifically, it was most likely because they had to prove that their new average inflation targeting framework was working, and they had to stick by this framework. Number 6, big shifts in aggregate demand that bounced back faster than expected, followed by a supply crunch and now a supply glut. But supply still hasn't caught up to where it was previously. Number 7, we have new and used cars and a general rise in the prices of many commodities. So that is a lot of causes. I will be exploring all of these in the video. But first, what is and isn't inflation? Inflation is the general rise of the price level across a broad category of goods and services. Inflation doesn't happen because a bunch of greedy companies just raise their prices and make inflation worse. It's not a matter of a single company raising its prices and therefore trying to profit from the situation, or that company making the situation worse. Inflation is merely the result of most companies having to raise their prices because of their own costs. An individual company may or may not know about inflation or even care, but they are responding to the situation they are facing. It just happens that they are not the only company doing so, and when enough companies have to raise their own prices, inflation is the result. It's important to note that sustained inflation is only possible when governments and central banks work together. That's because the central bank can quote unquote sterilize any stimulus attempts by the government if it deems that as appropriate. As an example of this, the Fed in the 1930s sterilized gold inflows into the US and stopped the gold from adding to the money supply. This exacerbated the drop in the money supply and the deflationary spiral that followed. But on this occasion, the Fed and the government played together. The important thing is that both central banks and governments around the world work together to help counter the drop in activity induced by these very same governments. It was all done to save jobs and prevent massive unemployment. There was an implicit and explicit agreement that while inflation might result, that this was a worthy price to pay in order to keep the economy going through the temporary downturn. Now, there are two important things here. The first is that inflation was going to be tolerated and central banks could be comfortable about this because in the past few decades in advanced economies around the world, we have seen very low to moderate levels of inflation, and central banks were seen as being in charge of inflation. The second is that they had inflation under control. So if inflation went up a little bit, then it wasn't an issue, as people would still trust that the central bank could bring inflation under control, and these people would not believe that inflation was here to stay. Essentially, people believed beforehand that any inflation would be temporary, that it would be transitory, to use that word from the Fed. Now, as mentioned, I made a number of videos where I proclaimed transitory inflation, and before then claimed that there would be no inflation. My basic theory was that since there was an induced reduction in activity, whereby you weren't allowed to spend money on goods and services like we traditionally would, and therefore the monetary and fiscal stimulus wouldn't be inflationary. This analysis was correct initially. The nuance here being that service prices dropped with the drop in demand, but the prices of many goods shot up as demand recovered faster than anticipated and people turned to shopping online instead of in person. Shipping rates spiked and it became much more expensive to ship goods, adding to the increased prices. And so in 2020, inflation was relatively tame. The idea then emerged that once shipping costs were lowered to much more normal levels and global trade opened up again, then goods inflation would start falling and the rising inflation of later 2021 would become transitory. And so there's that word that a lot of us latched onto. The idea being that the Fed adopted a new interest rate framework whereby they would look through temporary inflation, especially inflation caused by supply side issues. The big thing that the Fed, or any other central bank for that matter, didn't want to mirror was the mistake made by the ECB when it raised rates in 2011 and 2012 and then brought about the euro debt crisis. Yeah, that was a whole thing. And also the Fed wanted to show that its new framework was credible, and if it raised rates too quickly, then its new framework seemed pointless. We now have a war and we have China going into constant and swift lockdowns, both of which are disrupting trade and raising prices, therefore stoking inflation. But these aren't the only stories and not the biggest components either. The consensus now is that it's excess aggregate demand caused by excessively loose monetary and fiscal policy, and the fact that the Fed didn't move fast enough with raising rates. And so across many countries of the world, inflation is now very broad-based, touching most parts of the economy. But enough of that, let's dive deeper. What do the sources say? In source 3, the author looks at the similarities between the inflation of the 70s and today. He does find a few similarities, one of course being the high price of oil, but more importantly finds a few differences as well. Importantly, he says that what matters now is what policymakers do. He argues that acting decisively now on inflation creates the danger of bringing about an unnecessarily steep slowdown, Quote, against this, it is possible that demographic shifts, slowing technological change, deglobalization, exhaustion of important past opportunities for growth, and rising populism will weaken disinflationary forces in the long term. This would make achieving and sustaining low inflation even harder. End quote. And so, yes, the author is saying that inflation is here and that it's very damaging to the economy. However, in contrast to the consensus, he doesn't want the Fed to act too quickly. He doesn't want other central banks to act too quickly because we could bring about sharp and unnecessary recessions. The important thing is the point made about policymakers, especially to do with the Fed, and what matters is what the Fed does. And so this plays into the idea that the Fed has quite a lot of control of the economy, and indeed inflation as well. And depending on how the Fed reacts now, that will chart the course for inflation going forward. And so what the author might be saying is that on the one hand, we have the Fed and we have its excess stimulative policies that were simply too loose for too long. But on the other hand, we have all of these other factors now coming into play, and these could exacerbate the problems that we are already facing. And that the Fed's actions right now are going to be very critical for inflation going forward. However, we're moving on to the next source. Now, my point from this source is quite short, but source 9 says that yes, the negative oil supply shock is fueling inflation. However, the major factor is that the oil companies haven't invested heavily into new rigs or exploration for the past 5 to 10 years. And so, these same companies can't then just increase output in response to the supply crunch we're now facing. In other words, expect oil prices to remain high for quite some time. Sources 4 and 5 both discuss the recent yield curve inversion. And specifically source 5 discusses how the yield on 2-year Treasury notes rose above the 10-year for the first time since August 2019. It's noted that yield curve inversions have preceded every US recession in the past 50 years. The idea being that in normal times, we would expect yields on treasuries due further out to be higher, since you're taking a risk locking up your money for that length of time. When yields on shorter duration treasuries rise above the longer dated ones, it's predominantly because people are more pessimistic about the long-term prospects for the economy, and investors are worried about impending interest rate rises. And so, source 4 gives us a really interesting quote from a market economist at Jefferies, who says that the yield curve inversion is a sign that policy has become too tight. It's not just a matter of tightening monetary policy and reining in the stimulus. His view is that this is happening too much, too soon. And this would lend credence to the claim that the Fed has acted too slowly in the past, and should have started raising rates back in the second half of 2021. The idea could be that now the Fed is panicking and trying to get ahead of rising inflation, but that this will not just rein in excessive economic activity, but bring about a painful recession, and ultimately one that's unnecessary. From source 6, we see that goods as a percentage of consumption went up in January 2020 and has stayed high, whilst the share for services has dropped and stayed low. In other G7 countries, initially the situation began the same, but now services are a larger share of consumption. Quote, in a financially integrated world, a country can increase its consumption of traded goods by borrowing from the rest of the world and running trade deficits. Indeed, in our model, the regions experiencing the strongest increase in demand for traded goods adjusted by running trade deficits toward the rest of the world. This helps explain why the US trade balance deteriorated during the recovery from the COVID-19 recession, since in the US, the rise in goods consumption has been particularly pronounced. End quote. And so from here, it's possible for the US to export inflation around the world. This has exacerbated the scarcity of goods in the rest of the world and has also made the inflation and employment trade-off worse for other countries. Source 7 was written in June 11 and says that one of the biggest price rises was in sit-down restaurant meals. The author says that while the category has a small weight in overall calculation of CPI, it tends to be the single best reflection of underlying price pressures. And the author suggests that should this inflationary trend persist, then we will see yearly inflation of 6% in the US. The only bit of good news is that prices for many manufactured goods went down, going down around 2% on a month-to-month basis. And so from source 11, we see that it's oil, food, and rent that have gone up substantially in price since 2020. Also, the unemployment rate is extremely low, and teen unemployment is at levels not seen since the 1950s. However, even with wages increasing, this actually isn't above the general level of inflation, and in fact, real wage growth is falling, both overall and for production and non-supervisory workers. The lowest paid workers have seen the biggest gains over the pandemic period, but this has slowed in recent months. Initially, they were seeing amazing real wage increases, but now this has slowed down drastically. 2021 inflation was largely driven by cars and services, but this has since changed to food and energy. The source notes that core inflation, which excludes energy and oil, has been remarkably steady for the past 8 months. This fact won't necessarily help you if you're struggling with rising prices, but I hope it helps put the current inflation we are facing in perspective. Finally, aggregate real income is also up, which is how people can keep on spending. Just a small note from source 13, where the author agrees that the big factor playing out right now is the price of oil, which has pushed up services-related costs, such as those related to the travel industry. These price rises have offset a moderation in price for other certain goods. Housing costs were up 0.6%, the largest monthly increase since March 2004. From source 14, we understand that previous decades in most advanced economies saw a low inflation environment, often thought to be brought about by the rise in globalization. However, the authors argue that this is mere correlation and that the biggest factors were improved technologies which helped drive down the costs of goods, and those tended to be more trade exposed. So for example, they say that while a house might be cheap in Peru, someone living in Indiana can't live there. And they mention that the goods sector is where the benefits of technology reside, whereas the way haircuts are done now hasn't changed much over the preceding decades. And we then get the following quote. In sum, there are a number of factors, including diminished globalization, trade sanctions, a possible slowing in technology change, or the costs of measures to prevent or adapt to climate change, that could make the coming cycle different than the one that preceded it. But those differences needn't imply a higher trend rate of inflation, because the price level is still tied to overall demand, and that remains under the control of monetary policy, end quote. And so here we have another source agreeing that the Fed has a lot of control over inflation, and that the actions or inactions of the Fed have directly led to the elevated inflation that we are facing right now, and that same inflation that is going to be with us for quite some time to come. From source 15, we see that since February 2021, nominal retail sales have increased faster than real sales, whereas previously they tracked each other quite closely. The difference between the two is only possible because inflation is eating away your real purchasing power. In other words, you're now paying more to get less stuff. However, recently both real and nominal retail sales have both gone down, and if this trend continues, this could lead to a moderation of inflation. More importantly, it could be locked into the downward trajectory as people come to believe that the Fed will do what it requires to bring inflation under control. And finally, the paper finds that the price of cars went down 4.8% in May, which more than offset the 1.8% increase in April. Source 16 shows us confirmation that total retail sales in May slowed 0.3%, perhaps indicating that people think that prices are too high and they won't be purchasing anymore. Bad news to be sure, but perhaps a hopeful sign in that people now might think that price rises are temporary and that now is not as good a time to buy as prices won't rise too much further. And in the author's view, this is an indication that spending won't fuel future inflation. The author also believes that consumers believe the Fed's new tough stance on inflation will work and that prices will eventually start coming down. They do state that in the US, Q2 GDP is predicted to be lower. And then we get the following, quote, categories that are exposed to the cooling in the house market, including furniture, minus 0.9%, and building materials, plus 0.2%, showed weakness, with the latter category likely down in volume terms. Discretionary categories, including electronics, clothing, and sporting goods, are all likely to show contraction in volume terms as well, as higher inflation continues to squeeze incomes, end quote. And so once again, this source points to the role that the Fed has had in stoking and indeed making inflation worse, but also the role it will have going forward in bringing down inflation, and especially the role that consumer expectations will play. Basically, people have to believe that the Fed will be tough and consistent, and then people will behave accordingly. And this will be one of the things that will bring down inflation going forward. Source 17 reaffirms that US GDP growth is now expected to be only 1.7% this year and next, whereas previously the forecasts were for 2.8% and 2.2%. They also say that median forecasts show that interest rates will be 3.4% this year and 3.8% in 2023. The neutral interest rate, that is, the interest rate whereby the Fed isn't slowing down the economy or boosting it, the authors believe is 2.5%. Therefore, if interest rates do get to 3.8%, this could be very bad news for the economy. Source 18 focuses on Australia, but discusses how the RBA will very much mirror the moves of the Fed. And so what happens with regards to inflation in the US will have flow-on effects here. The authors predict that we haven't seen that peak of inflation because it is now very broad-based, and now services inflation is also picking up. They also discuss now that inflation expectations may have started to de-anchor, which means that short-term price rises can change long-term expectations, making the job for central banks that much harder. It also makes the situation worse for the rest of us. The 5 to 10 year inflation's expectations measure out of the Michigan Consumer Survey rose 0.3% to 3.3%, the highest since June 2008. That makes investing a lot harder and the potential to bring down the economy and lower potential GDP. The Australian market is pricing in a substantial slowdown for 2023. The paper also points out that the Australian household sector is more sensitive to rate hikes, given the high share of variable rate mortgages. From source 19, another short section, we see more bad news, this time on the housing front in the US. I won't go into the details, as you definitely need to read this for yourself. However, the long and short of it is that the US isn't building enough housing, and house prices will remain high for the foreseeable future. Supply will not meet demand. Good news if you own a house and have paid it off, bad news for pretty much everyone else. Source 20 is a little bit different and discusses 3 wildcards that could drastically change the inflation picture going forward. The first is the financialization of the economy, where low interest rates combined with QE has raised both asset prices and debt levels. So rising interest rates increase the cost for the government to borrow, and if markets stay down, this could mean tax collection could go down as well. The next wildcard is housing, and not in the same way prior to 2008, where there was a surge in mortgage applications. Actually, mortgage lending in the past few years has been of higher quality than what we saw before. And so, as rates rise, there is less risk of forced selling by people whose mortgages were larger than the equity in their homes, causing a massive price drop in housing. Instead, now we're seeing a massive shift in working from home, which is causing a massive increase in house prices. The final wildcard are the labor markets. The author actually believes that inflation of wages and the potential of this causing a wage spiral is overblown. As proof, the author points out that the CPI in May was 8.6%, while wages were up 6.1%. And so the author concludes that inflation isn't driven by employee demands or stimulus, but by long-term Fed policy and politics, those politics namely being the war in Ukraine. The author from Source 21 suspects that housing is a big driver of inflation, pointing to strong demand. And the author doesn't believe that people think that deficits will widen or that money printing would be used to finance the wider deficit, because if that were the case, the US dollar wouldn't have strengthened recently. Following this line of reasoning, people think that the deficit will shrink in coming years due to higher interest rates working their way into the economy and slowing down activity to ultimately bring down inflation. From Source 26, the author states that in 2021, the causes of inflation were: number 1, monetary stimulus; number 2, falling US dollar; number 3, increase in commodity prices; number 4, rising energy inflation; and finally, number 5, 18% durable goods inflation. However, now the author points out that monetary policy is contracting and that the monetary base is contracting at a 10% rate, and reserves in the banking system are falling at a 28% annualized rate. And then, like previously mentioned in the other source, there is now excess inventory, which should lead to a small period of goods deflation. The author points out that energy inflation has also re-accelerated. With regards to commodities, it's all still about oil. And the author says that food inflation is expected to keep on rising. He then says that the story is now largely of industrials, metals, food, and energy. The US dollar is rising at a 3% annualized rate, so no inflation from a low dollar. With the rise in the federal funds rate, the overnight interest rate, employment growth is likely to cool down. And then the author says that wage growth will follow the overall employment growth, and so we shouldn't expect inflation to increase because people are demanding higher wages. And so with regards to the 5 factors that is contributing to inflation that the author mentioned, he then concludes that these were previously pro-inflation, however they will become pro-deflation soon. He then concludes that it's down to the war and that inflation through oil and food that are now causing the biggest concerns right now. Source 22 is really interesting because it lays out the story of what's happening with the demand for goods and how this has impacted the retail sector. And so, in March 2020, stay-at-home orders go out, but more than that, people are choosing to stay at home out of fear for the virus. Demand for certain goods skyrockets, such as masks, hand sanitizer, and essential supplies. Retailers react fast by increasing their purchases of these items and purchasing far fewer non-essential items. There is then a 2-month period where orders from Chinese factories falls dramatically. The author claims that this is where the supply problems start. The basic issue being that the global supply system is extremely fine-tuned and optimized, but the 2-month pause broke one link in the chain and impacted the entire supply chain system. Government stimulus comes along, and there's hope that a vaccine will be out by the end of the year. People are now purchasing non-essential items again, but spending habits have changed. People are now buying for their homes, so things like home workout, renovation materials, air fryers, etc. Now companies are ordering again, but in much larger quantities to account for normal ordering they would do, plus the new demand, and to make up for production that was lost. And this is where we start to see massive shipping delays. And then these delays cause many retailers to order even more products. 2021 holiday season. So products that are meant to arrive in October get delayed by a few months. The only way all stock arrived in time for the holidays was that every retailer paid extra to get it shipped. Early 2022. People are now going back to the office, and people stopped buying as many things for the home. Now people are shifting into services. Now there is tons of extra inventory because demand was less than expected for certain goods, and as an example, the author cites Peloton and their collapse. Now the author claims that there is excess inventory and that retailers are finding it difficult to make room for other goods they want to sell. The author then says that in the coming months there will be many sales and lower margins for everyone, and that the next issue for the retail sector will be to have too little stock rather than too much. Let's end with a really interesting perspective on how the Fed fell behind the curve. Source 25 asks why the Fed started raising rates so late. August 2020 is when the Fed launched a new interest rate framework, average inflation targeting, where basically this gives the Fed more flexibility with regards to their interest rate target. The context here is that inflation for the previous 15 years has been below 2%, and this is considered bad. So previously, the inflation target was 2%, and the Fed had to act if inflation went above this mark. However, this new framework allows them to make up for past misses of the 2% target. And so, if inflation has been below the 2% mark for a few years, then the Fed won't immediately react if inflation rises above this mark for a few years after. The Fed is, after all, taking the average inflation over a longer period of time. What is that period of time, you ask? 3 years? 5 years? 10 years? Not sure, and not even the Fed was willing to say. This gave them a lot of flexibility when it came to reacting to inflation. And so the Fed was committed to keeping interest rates at 0% until they achieved maximum employment. In June 2021, the unemployment rate was 5.9%, and by December that year, it was 3.9%. And the author then argues that the Fed tolerated rising inflation and famously or infamously called it transitory because it needed to show its new framework was credible. In March 2021, the Fed didn't react to the 1.9 trillion stimulus, even though this was beyond what they had anticipated. Inflation forecasters are using an expectations augmented Phillips curve model of inflation based on the past few decades of performance. This model was developed when inflation was around and under 2%, but broke down when inflation soared past that mark. And so the rising inflation was dismissed as essentially background noise since it couldn't be explained by the model. And finally, the author talks about the Fed being scared of what happened in 2013 and the quote, taper tantrum, whereby the Fed started dialing back purchases and the market reacted negatively, and the Fed was forced to change course. The Fed didn't want the taper tantrum to happen again and to cause panic in the markets and make the overall situation much worse. And so what I hope I've shown in this video is that inflation is now very broad-based and it's almost certainly here to stay. I hope I've convinced you that I have a relatively complete, or at the very least mostly complete story, and one that is truer to reality than what I was trying to spout before. Before, I was easily able to dismiss inflation even as it was picking up, and I was definitely, of course, on team transitory. That is definitely not the case, and it's going to do quite a lot of damage going forward. Of course, I have mentioned that the war is contributing to inflation. However, even absent the war, I hope I've shown that we would still have inflation, and one of the big contributing factors is the excess stimulus enacted by governments and central banks around the world, but especially the Federal Reserve and the United States government in 2021. Also, the Fed was too slow to react, and so now we're here. We're all dealing with it. Even though I've been talking a lot about the Fed and the United States government, this impacts the rest of the world. I've shown that the United States has essentially exported its inflation, and almost all advanced economies around the world are experiencing inflation right now, almost as a direct result. And so what I hope I've done is redeem myself and shown that this time I've got a much more complete story and that you can trust my videos going forward. And so if you have any questions, don't hesitate to ask below and I'll do my best to answer. or at the very least, I'll collect the questions and answer them in another video down the line. I also hope that you'll subscribe and share my videos so I can reach a wider audience and also eventually make money, because that would be amazing, and I guess in a third-hand sense will also make you happy as well. But thank you for watching this video right until the end, and I hope to see you guys next time.